to our third spring talk, co-organized jointly by the European Banking Institute, the EBI, the University of Turin, the EUSFiL, and the Associazione di docenti di diritto dell'economia in Italy. Even though here in Athens we have already summer, we are still in spring talks, yeah. And today we have another very interesting topic on sustainability in the financial sector, and the moderators for that could not be better than my dear colleagues and friends in the academic board of the EBI, Georg Ringe and Serena Grunewald. Without further taking out of your time, Georg, you have the floor.
Thanks so much, Christos. It's a great pleasure to welcome you all, to welcome our excellent speakers for this afternoon, and to introduce a little bit the topic that we are discussing here this afternoon. So, as you all know, we are discussing sustainability in finance, and this is a topic that nobody can escape from. Everybody is aware that sustainability, however you define it, I hope we get some clarity on this afternoon, is increasingly being found in policy agendas around capital markets and financial regulation. So capital streams worldwide are instrumentalized in order to reach sustainability goals. I think there is growing consensus worldwide on that fact. It's more about the how do we get there, right? What are the right incentives that we set? In the absence of any world government that can direct things top down, I think it's important to get some cross-country clarity on what instruments do we use, how can we most intelligently harness the power of technology in this field, and what are intelligent ways of encouraging investors to make use of transparent information in that direction. So we have three excellent contributions this afternoon from Agnieszka Smoleńska, who will speak first. Giulia Schneider will be second, and third, Federico Riganti. We will introduce them in turn, and it's my pleasure, first of all, to hand over to Serena, who will lead the first discussion. Thank you.
Thank you very much, Georg, and also Christos, for the introduction. A warm welcome also from my side. I much look forward to the discussion today. I have the pleasure to introduce our first speaker, as Georg already announced, Dr. Agnieszka Smoleńska. She's an assistant professor at the Institute of Law Studies of the Polish Academy of Sciences, and we can be proud to also call her a member of the EBI's Advanced Researchers Group. Thank you for being here today, Agnieszka. Agnieszka leads a 3-year grant-funded research project on the EU's sustainability capitalism, identifying the varieties of financial markets transition, a law of political economy approach, which she will present to us today. We are extremely curious and look forward to your presentation. The floor is yours, Agnieszka.
Thank you so much, Serena, and of course also Georg and Christos for the introduction. It's a real pleasure to share with you today my project, which will last 3 years. So I very hope.
Agnieszka?
I think you're mute.
Yes,
Agnieszka,
you muted yourself, I think.
Okay, let me.
Yes, now it works.
Does it work now? Okay,
yes.
Excellent. Okay, I think it was. Apologies for that. Okay, I believe you can see my presentation now. Is that right? Okay, so I'm not sure if I muted myself before I thanked for the introduction, but thank you again for this opportunity to present a project that will last 3 years. So what I will present to you today is the thinking behind the project, the problem I've identified, and the methodology that I'm developing in order to address the problem of EU sustainability capitalism and the main motivation here is really trying to understand better what sustainable finance regulation will do on the market. So thinking about regulatory impact of the measures that the EU is putting in place, and developing a framework from a legal perspective that also incorporates political economy thinking. So thinking about power and how specific regulations that are being introduced by the EU and across its member states affect different types of power relationships in financial markets. And just as an introduction, just something to give you an example of the thinking is the concept of transition risk, right? So we have this idea of sustainable finance as creating this market that for sustainable products. We have this idea of channeling capital flows towards green investments. And yet, at the core of a lot of this regulatory activity is a concept of transition risk, which relates to the impact of policies that we are introducing on banks themselves as well. So on one hand, this concept of transition risk relates to some known categories of risk that we know already, but thinking about it a little bit deeper makes us realize how multifaceted the transition is. So it's not just about exposure to climate change consequences, but it's exposure to policies, state policies. So even as regulators are putting in place new tools to mitigate, to help financial institutions mitigate these transition risks, they are also the source, right? Because there is this dependence of private transition on public transition, and we can see how the policies that are being developed in order to counter emerging climate and environmental risks are also including the policies that the policymakers are themselves doing. So there is some endogeneity happening here. Now, in my presentation, as I mentioned, it's a 3-year project that I've just started, which will be carried out at the Institute of Law Studies and a Center for Transformative Private Law in Amsterdam. And what I'm interested in is taking the example of sustainable finance regulation, understand what the EU is doing, what EU law is doing across a variety of institutional contexts. I will introduce you to this project in the 20 minutes that I have. First, starting to make sure we are on the same page, briefly outlining the sustainability finance regulatory wave, and it's very much a wave from the number of different policy instruments that are being put on the table. Secondly, I will discuss with you the rationality of regulatory design, so what it is that the EU says it's doing and what is the logic that is underpinning the regulatory design. I will discuss these critically, so discuss whether these policy tools are likely to do what they say they will do, and present some what I think are missing pieces in the framework of thinking about sustainable finance, and subsequently outline the next step of my research over the next 2.5 years. So starting with the pillars of EU sustainable finance regulation, I think they are broadly 5. First is this common understanding of sustainability. So the green taxonomy regulation, this magical instrument that allows finance and business to develop a joint understanding of what it means to contribute to one of the EU's environmental objectives. So it's taxonomy is a dictionary. It is a common language to create a common understanding of sustainability through specific thresholds relating to business activity. This common understanding subsequently informs a variety of labels that are being placed on the market. So since we understand what sustainability means, is the logic behind the framework, we can call stuff green. So we can have green bonds, we can have low carbon benchmarks, we can have product disclosures under the SFRD. Once we can call products something, we can have institutional disclosure. And this is what a third area of regulation is trying to do. So we have the green asset ratio, for example, so the percentage of the balance sheet of a bank which is conforming with the taxonomy criteria. But this is just the beginning. We have much broader Pillar 3 disclosures for financial institutions, very granular when it comes to physical and transition risk. And there are also ideas for new transition plans to be presented by banks to give teeth to their commitments of net zero balance sheets by 2050. In the context of financial institutions, we have the risk management area, which is currently developing very quickly. So since we've called the environmental and climate risks, we can develop policies to ask banks to manage them through specific, let's say, operational changes or thinking more about risk management of C&E risks, as the ECB is currently trying. There are further instruments being developed, and only yesterday or the day before, EBA published a discussion paper on possible capital requirement specific risk weights for C&E risk exposure. So we have this risk management pillar of EU sustainable finance regulation. And the fifth one is something very interesting, especially for consumer law scholars, namely the idea that a recent MiFID change introduces so the sustainability preferences of investors that are pretty much implied. So you have this in this world of green products, you also have a an investor with sustainability preferences. So the investor is assumed to want to invest in this particular way. Now, when we take a step back from this array of regulatory instruments, and we ask the question, okay, so what it is that the EU is trying to do, there are three objectives that are typically presented. So EU sustainable finance regulations claim to reorient capital flows towards sustainable investment, mainstream sustainability in risk management, and foster long-termism and transparency in capital markets. Now, when we read the impact assessments, which are always fascinating documents prepared by the Commission because they really show you the logic behind regulatory design, we get this very neoclassical economic rationality thinking, which is quite fascinating when you think about how many aspects are related to of sustainability, right? So we have this, there's in the impact assessments, you find this perfect market design where to create the market and the right incentives. The neutral financial markets will efficiently incorporate this new green information, the lowering of transaction costs, which will allow for the creating of sustainable finance products. And once we have these sustainable financial products, once we have these new sustainable financial product markets, this will help solve the problem of inadequate funds. So we will have this huge flow of capital towards green investments, especially if investors are gently nudged in the right direction by the regulation prescribing them the green preferences, so sustainable preferences. Now, this is a very nice picture. However, there are varieties, and I think the topic of Federico's presentation, blah, blah, is that sustainable finance is a good summary of the different types of criticisms that are out there. Here I'm pointing to some concrete ones. So first, above all, there is this concern of ineffectiveness and incapacity of this sustainable finance regulation to make a meaningful contribution to climate change mitigation. This is because what we are targeting are only the green finance projects. There is less of a thinking about broader transition context, surprisingly. Secondly, there is a worry about incoherence with broader financial regulation. So there is a concern that we are introducing non-financial objectives into microprudential and also macroprudential framework that are not kind of based in thinking about risks, safety, and stability of financial institutions as we are used to. The kind of broader criticism points to the fact that sustainable finance is just reinforcing the legal steroids of capitalism. That's Katarina's Pistor argumentation, or the Wall Street consensus. So this idea that all of this green finance efforts are just about making it easier for finance to invest and socialize the costs of transition and give all the profits to the financial sector. There are other kind of problems with this theoretical, with this framework underpinning, so this the rationality that if we have the sustainable finance products, then the problem of inadequate funds for transition will be solved, relating to incompleteness, inconsistencies, analytical mismatch. But what the main thought that I wanted to convey is that few commentators really expect the sustainable finance regulation to do what it says it will do. So the framework that is underpinning the regulatory design has really little predictive value, and at the same time, given how far-reaching this regulation is, it is clear that it will do something, and that it will do something important when it comes to the relationship between the different participants to the financial markets. And this is precisely the problem that I find very interesting, and something that I want to address in this research project. So trying to think about what it is that financial regulation, which tries to make capitalism sustainable, what will it do? How it will change the relationship between the different actors in the financial markets? And to do this, I've identified 3 steps. So first, there is this thinking about hybridity of the sustainable finance efforts. So this approach of private sustainable product markets is just not really realistic in a sense. So it's the question of how do we think about the hybridity of transition. Secondly, once we acknowledge this hybridity, which also involves looking at the different national institutional contexts, we have to think about how these sustainable finance regulations will operate across the EU. So it's unlikely that these regulations will have the same impact across all EU member states. And thirdly, to really determine the impact, we need to get quite granular and look at the relationships between the financial market actors that are affected by this flurry of regulations. So starting with this hybridity of transition point, there is already ample research. Well, there is already a perspective, especially again, Katarina Pistor and Simon Deakin, a legal institutionalist perspective, which helps to capture the missing hybridity of the sustainable turn in financial regulation. So here the idea is that markets are not just private markets, and especially because of the reliance of financial markets on the state, essentially on the public backing of money. But here this interdependence goes even further, right? So we have this interdependence of private and public, national and EU transition pathways. And this seeing the hybridity of the sustainable finance markets points us to a number of political features. So first, there is an industrial policy element to sustainable finance policies. For example, the taxonomy is in many ways an industrial policy instrument because we are trying to push the money in the direction of what has been deemed sustainable, and despite the best efforts to kind of make it very technocratic instrument, the discussion around gas and nuclear and whether they are sustainable or not clearly shows this political and industrial policy element. Secondly, there is this element of regulatory de-risking, so various ideas around green supporting factors, so measures that look like risk measures, risk regulations, but are in the end about pursuing other policy objectives, in this case accelerating the transition to climate neutrality. And there is also kind of just a structural element in discussing sustainable finance, so just the high level of different forms of either public ownerships or very far-reaching presence of regulators and public authorities in the markets affected by the transition. So once we see this hybridity, it also, what becomes very relevant is the different experience, right? So it's quite unlikely that what the sustainable finance regulations will bring will be the same across different institutional contexts across the EU, right? So we have very different depth of capital markets. So even if we look at green bond issuance, there is clear, very high variation across the corporate green bond issuance, but also sovereign green bond issuance. There are different standards of corporate governance or different level of interest in sustainability related issues in the context of corporate governance. The financial markets work somewhat differently. This again comes back to this point about the depth of capital markets, and there is also different monetary policy context, right? So we have the different central banks across the EU. And this really makes for a question that is really important, namely, will there be functional equivalence in what the sustainable finance regulations will do across the EU? So will it accentuate the differences if we take this varieties of capitalism perspective, or will this be an opportunity for legal experimentation across the different markets that will really enable the acceleration of the transition to a sustainable future? And this is just to show kind of the specter, the difference in the markets. And this is obviously not something that is just EU specific. It's much of a climate finance landscape varies enormously across the world. Now, once we've established that it's meaningful to look at kind of the power dimension, and that this can be quite varied across different member states, it's time to get a very granular and think about different relationships between the financial markets, market participants that are affected by sustainable finance regulation. And here here that we get to really the meat of what I plan to study over the course of the next 2.5 years, namely that much of sustainable finance regulation works by affecting specific relationships between market participants, and this relates to costs and access to credit, and that this has redistributional effects as well. So to flesh out this, we must think about how sustainable finance affects the creditors and the debtors. And we have to think about the different transition financing needs. So one thing is green investment, the green taxonomy, but there is also now an increasing interest in the transition, as well as the question, which inevitably should also be coming up in the context of sustainable finance discussions, namely what happens to the stranded assets and how do we absorb the losses that have to happen if we are serious about the transition. So who absorbs these losses? An international political economy perspective helps to recognize, to see these different power relationships, and these are borrowing on Katarina Pistor's Code of Capital book, Coded in Law. These relationships are not necessarily symmetrical. There is a power dimension to them, and this is recent research done by Ben Brown and Kai Kodenbrock in a book that is coming up this year, which looks at different power relationships in the market depending on the life cycle of the financial product. So they identify leverage, instrumental, infrastructural, and enforcement powers. This is just a framework for capturing how the debtors relate to the creditors, what is the power of infrastructure providers in the market. It is very helpful if we want to understand the regulatory intervention, how the regulatory interventions relating to sustainable finance may change these relationships. And just some examples to close. So clearly, there will be distributive effects in terms of power of introducing a default sustainable preference of investors. There will be a strengthened leverage power of the financial sector vis-à-vis the creditors as a result of instruments such as the taxonomy. The effect of the regulation is to strengthen the infrastructural power of ESG rating providers. And we also, especially in the context of green bonds, need to think about how this affects the power of the issuers and the creditors. And this is exactly these kinds of changes in the power relationships is what the project will analyze in a variety of markets across the EU. So where does this leave us? Sustainable finance is unlikely to do what it says it will do, i.e. deliver a green transition by making investment in green technologies cheaper immediately. That's clear. It will do something. And the argument that I wanted to present in this really esteemed context is that there is broad scope for legal scholars to investigate also empirically the impact of sustainable finance regulations on the different relationships in financial markets, not just in legal terms, but also in these political economy terms, thinking in power terms, and thinking in the consequences of institutional differences in how these power relationships are affected. To zoom out once again, if this political economy impact is confirmed, and especially if it shows a sustained increase in the power of financial actors vis-à-vis the non-financial actors, this will provide further evidence of EU's contribution to the development of financialized capitalism, and inevitably, in the context of the current socioeconomic framework, that will mean that we'll need to ask questions about safeguards to make projects such as sustainable finance just and democratic. Thank you very much for the attention. I'm a little bit worried that my internet connection might have been imperfect, but I hope it didn't cut too much. So
yeah, thank you. Thank you very much, Agnieszka. No, there were a few glitches, but I think we could follow your line of thought and your argument, so don't worry about that.
Okay,
thank you very much for your presentation. This is a really intriguing and ambitious project that you're working on. Thank you for sharing it with us. I would suggest that we have a very brief discussion now after this paper presentation, and then we will have a presentation of all three, a discussion of all three presentations in the end, sort of to tie them together. Now, I have a few comments that I would like to make, since I find myself in many of the criticisms that you mention of the EU's green finance approach. And perhaps we will come back to that in the final discussion again. in particular, the last point that you mentioned, the inconsistencies in terms of approach, or maybe also the masking of which approach is actually being pursued. So often it's the argument is risk-based, whereas the effects are probably not necessarily risk-related, but really have a sort of a more of an impact background in mind. So obviously we all know that prudential and environmental goals can be mutually reinforcing, but they also can create trade-offs, in particular in the short term. So so I think that's an important point to make. One reason I would assume that is behind this sort of masking of often of the impact-driven sort of notion behind sustainable finance regulation is arguably that environmental goals, if they're not or completely disconnected sort of from financial risk perspectives, they're not perceived as falling within the mandate, right, of financial regulators as we traditionally see it. And there is a path-dependent reluctance, of course, also to stronger coordination between financial, fiscal, and environmental policy, as it would arguably be needed to really create impact. Now, this brings me to 3 points I'd like to raise, or 3 questions that I have. The first point concerns the first step that you mentioned in your 3-step program, which I found very instructive. Acknowledging that there is a 3-way hybridity, as you call it, of the sustainable finance efforts. And you describe that these efforts are subject to interdependencies between private and public and national and EU transition paths. Now, I wonder whether there is not a 3rd dimension that plays a role here, namely the financial sector, real sector transition paths. Or my question to you, or would you say that it is clearly the financial sector that drives the transition of the real sector and not the other way around? So how is this relationship there? That would be question number 1. Question number 2 is, I do think you have a very strong case in looking at how the transition may vary in different corners of the EU and what might be the drivers of such variation. And I'll much look forward to reading about your findings. What I did not find in terms of such drivers on your list are the institutions themselves, including perceptions of independence. I would imagine that these perceptions are very strong in jurisdictions such as Germany, and perhaps less strong, but that's just an intuition in Central and Eastern European jurisdictions. Is that something that you look into? And just briefly, point number 3, a point that you made in the very end again, in the beginning and at the end, that sustainable finance regulation is endogenous. And you mentioned that there is hence the need for reflection on how to make it a just and democratic process, which I very much agree with. Do you have particular safeguards in mind for that? And for, sort of what springs to my mind are 2 key aspects. The first I mentioned already is the mandate. How to square the prudential mandate of financial regulators with the environmental impacts that their policies generate. In particular, because as environmentalists tell us, doing nothing is the worst thing you can do with a view to climate change. And the second aspect is also already mentioned, independence, since arguably much more coordination is needed because between all different kinds of public policies. But I don't want to take further off the time. Maybe you can just briefly respond, and then we move on. Thank you very much.
Thank you, Sciarrone, so much for these wonderful comments that really started a number of processes in my mind already. So I will, mindfully of the time, just briefly engage with a few of them. First, on the impact on the issue of lack of clarity of objectives. So whether we are going more for this risk-based or a policy or a greening policy objective. So do we want to shift the gears of finance by thinking about finance, or if we want to essentially have the money flow directly to green products irrespective to green investments irrespective of the risk. We have a paper with Jens van Klooster which specifically looks at this issue in Journal of Financial Regulation, which was just published a few weeks ago, and it specifically looks at the two routes forward, one differential, more risk-based, one more policy goal alignment oriented, so more of a guided transition. And I have to say that one of the reasons that we embarked on this research project was our surprise about the confusion. So how intertwined these projects were, and these two policy routes were, and the lack of clarity in the regulation itself. So this tells you also something about the regulatory process, where you have a lot of ESG related articles in the 2019 CRD/CRR amendment, but no real clarity in the recitals of the regulation as to why, which, yeah, but this is a policy process aspect. When it comes to this confusion, there is a clear I think issue, which is not just the mandate issue, but Article 194, which I think we sometimes forget, namely the energy mix sovereignty of member states. And clearly, because of this industrial policy aspect to sustainable finance, which clearly calls some things green, some not, really fleshing out this could be, I think, argued to go against the energy mix competence of member states. And this is if someone wants to do a research into this area, how sustainable finance works with Article 194, I think there is fertile ground for further research. When it comes to your question number one, namely the relationship between the real economy and the financial sector, this is one of the I can see the reason for disentangling the two and treating them separately. And in fact, in looking at the different claim relationships, so the relationship between the creditors and the debtors, this is something that I'm really looking forward to unpacking in greater detail, in particular on the example of transition plans, which are likely to work by engagement from financial institutions with the debtors, right? So we will end up with if this works as it is currently envisaged, so that financial institutions are to outline their transition to net zero by 2050, that means that they will need to have a plan of engagement with their non-financial counterparties, right? Which means that there will be the financial sector will end up being some kind of a mirror between what is happening in the financial sector, in the real economy, and in the economy as a whole. Secondly, these institutional drivers, certainly independence is something that is a constraint of varying levels. And I think here the fact that there is some pushback in Germany against sustainable finance, and Hungary is embracing it with open arms, clearly says something about kind of the level of independence of institutions, or at least how institutions perceive themselves, or what they see as a constraint or independence or not. And just to briefly think about these the kind of just democratic conditions for sustainable finance, I mean, in another strand of my research, I looked a lot at various mechanisms of accountability in financial sector oversight, in terms of accountability vis-à-vis democratic bodies, accountability vis-à-vis not stakeholders of different sorts, reporting, but also kind of more of a meaningful engagement, interinstitutional accountability. I mean, clearly sustainable finance is not something that can stay just within the world of financial sector regulation. So even when we are discussing different forms of regulatory requirements concerning disclosures or transition plans in particular, this cannot, I don't think it's right if it's just the financial supervisors being involved. We need environmental agencies, different stakeholders being engaged in this process. So accountability is a good catchword for institutional safeguards, but of course accountability itself can mean a number of different things. But thank you so much. This is really very helpful comments at this stage, and I look forward to reporting back over the next few years.
Thank you very much. We look forward to that as well. I wouldn't want to move on without giving Georg the opportunity to follow up with questions he may have.
Thank you, Serena. I do, but I'm a bit mindful of time, so maybe we move to the next paper now, and then we have ample time for sort of overall questions towards the end, if that's okay. Yeah.
Excellent. Yeah.
Okay, then I'm happy to introduce our second speaker. A great pleasure to welcome Giulia Schneider with us. She holds a Ph.D. in international law and economics from Bocconi University, and at the moment she's a researcher at the Catholic University of Milan. Her paper is taking us into the corporate governance field, and an interesting piece of research because it bridges the sustainability debate with technology, and in fact that's how I see it, the hallmark of her research so far. So we very much look forward to your talk, Giulia. You have 20 minutes. Thank you.
Thank you very much, Professor Ringe, for introducing me. First of all, thanks for the EBI for hosting this very interesting talks, for Federico, for making all this possible. Now I'm trying to share my screen. Now you should see it. So my talk here today intends to contribute to the debate of sustainable finance with a perspective, as Professor Ringe was mentioning, to the corporate governance pitfalls of sustainable, of the sustainable finance paradigm, with a particular focus on technology-related sustainability or unsustainability risks. So these are the very early findings of the research that I'm planning to bring forward in the next times, in the next years at least. So the starting question of the research, the moving question, is exactly relates to the interactions and the mutual relationships between different branches of European financial policy and regulation, which are shaping at the very core the European financial market countenance. This is starting from the Sustainable Finance Initiative, moving to the digital finance strategies, and getting to the top of the open finance, the forthcoming open finance strategy. So my goal is to identify interaction between these three branches of European financial regulation, noting from the very beginning that these three major lines of reform, of development, are really shaping, when it gets to sustainable finance, the objectives, or at least the interest that financial market regulation has to consider, has to take into account. In respect to the digital finance strategy, we have a focus more on the means. So it is about making the European financial market capable of leveraging the opportunities given by technology, and with that, financial technology and AI-related technologies. When it gets to the open finance strategy, we are dealing with the structures of financial markets, which in the intention of the European legislator is meant to become increasingly open, this leading to increasing interactions among different players acting in the markets, in the financial markets, and what is important to stress, not only regulated entities. So it's a change that is dealing and comprising with these three elements: objectives, interests, means, and structures of the financial market. And if to date, my sense is that in this mutual relationship perspective, greater attention has been given to how digital technology, how open banking and open finance model can contribute to the achievement of sustainable finance objective, I see that less attention has been so far given to the adverse impact that the digital transformation of financial market, that the open transformation of financial market can have to the achievement, or at least if we do not want to talk outright of objective, to the consideration of non-financial interest in the context of financial markets. So my second question is here related to which are the possible governance structures that can properly deal from a corporate governance perspective of financial entities with this adverse impact, if you want to call them risks related to digital finance and open finance, onto the consolidation and establishment of the sustainable finance paradigm. And a third level of analysis intends to deal, once having defined the corporate governance structure, intends to deal with the internal controls, which can be relevant and in order to effectively deal with these risks. So in order to address these three major questions, my study moves from three major assumptions. One, a very general assumption, is that, as very well known, European financial regulation and policy takes, and with that also ESG-related regulation, moves from a technology-neutral approach. This technology-neutral approach actually engenders a misalignment, or if not an outright trade-off, for the achievement of sustainability objectives. This because the maintenance of a technology approach impedes, as also discussions in respect to the AI Act have been very well highlighted, impede the consideration of the sustainability impacts of technology. If we look at not only financial regulation, but also the broader picture of technology-related regulation, there is no reference to be found to sustainability requirements. This we can see in the name of the maintenance of this technology-neutral approach, but this impedes from the very bottom to account for the impact of digital technology onto sustainability objectives. So the second assumption is that although the European digital strategy establishment a commitment to greater focus and greater highlight the interdependencies between the digital and sustainable finance, to date no sufficient attention has been given to technology-related sustainability risks. So there is no regulatory or policy call for the internalization and for the concrete consideration of these specific risks in the context of European financial markets. Assumption number 3 relates to the very top of our policy-related triangle, relates to the open finance, to the forthcoming open finance and open asset paradigm, which actually is destined to amplify these technology-related sustainability risks. The whole open finance model is indeed about opening up data set, making data accessible and reusable by various market players, and the very goals are, of course, that of enhancing financial services, their quality, their variety, and in a digital finance, system. Of course, this relates also about providing new technological solution and advancing and incentivizing competition and innovation regarding these technology-related solutions. So, of course, while amplifying the area of digital finance and of technology-related solution, this, of course, also comes to amplify technology-related this. And among these risks, a specific subset of this risk is to be considered that of technology-related sustainability risk. Of course, the open finance model and paradigm also open up new governance opportunities of the same risk, because it's all about the availability and the enhancement of informational fluxes regarding also, as we'll see in a moment, ESG-related data and information. This could provide a very precious source of information also for financial entities and at corporate governance level for addressing these risks. So, and in light of these three assumptions, my two claims are exactly related to the governance of these what I have called technology-related sustainability risks, and the need of developing appropriate governance structures. And I think that this a starting normative benchmark, first normative grounds for the development of these governance structure could be found in a combined reading of the DORA regulation and the proposed corporate sustainability due diligence directive. Of course, these are just proposal, but they are giving a sense towards where the regulatory pointers are looking at, we can say. And claim two is that exactly these two proposed frameworks provide first normative ground for the construction of financial institution corporate digital responsibility paradigm, moving from this notion of corporate digital responsibility, which has been developed at policy level, but has not yet been contextualized in financial market. And I think this could provide interesting perspective exactly for the governance of technology-related sustainability risks. So moving from the first part of our triangle, open finance. So exactly underlying the reform of the Payment Service Directive 2 are two major goals, namely related to the account of new risks related to the emergence of new business models exactly based on the access and the sharings of payment account data, and the transformation of this open banking model into a broader open financial asset model, which is envisaged under the legislative proposal on open finance. One of the another concern underlining the upcoming reform of the Payment Service Directive 2 regards that of coordination of sectoral regulation with the broader realm of the emerging and consolidating European data strategy, which is being increasingly made up by regulations which exactly encourage and if not outright demand the sharing of data. And this occurs with the Data Act, with the Digital Service Act, the Digital Markets Act, and so on. So the reform of the Payment Service Directive 2 exactly intends to coordinate this different level of vertical and horizontal regulations regarding data governance model. And in this need and command of providing a coordinated data governance model is not without relevance, also, as we will see in a moment, from the perspective of the governance of technology-related sustainability risks. Of course, this, as I said before, this objective of opening up financial assets, first of all data, has, as I was already mentioning, the goal of incentivizing competition and innovation, of developing different business model based on technology and data-driven solution, but also further and more specific benefits, if we can call them, have been identified. For example, I find very interesting the observation by a recent paper by Calzolari, which highlights the importance of opening up the black box and the data sets of financial entity in order to stimulate the production of varied financial technology solution, exactly because this benefits, exactly in light of the fact that technology solutions are increasingly taken as decision-making tools. The variety, the stimulation of variety of technology-related solutions help to prevent coordinated behavior, which has also an impact on market integrity and financial stability. But if we look apart from these general benefits, broader to the link between open data and financial sustainability objectives, a positive link can be surely found. And this even before the institution of mandatory model, also at voluntary level, is that what is already occurring in respect to ESG related products, green investments, that of course make it increasingly important for financial entity to collect and make use of ESG related data, and more specifically to data regarding ESG preferences. This relates to the rise of so-called ESG data provider, which are well documented by the recent acquisition by Goldman Sachs and JP Morgan of two ESG data collectors. On the one hand, Gridpoint, and on the other hand, ESG Open Invest. As I was already mentioned, this ESG data, which we have to think also is contains also very sensitive data, also personal data regarding the ESG preferences of customers, further and additionally serves the development of AI models for ESG rating, for identifying and orienting green investment, for customer monitoring and profiling, and for raising customers' awareness over ESG issues in order to go back to ESG relevant investments. And also stepping apart from the AI realm, also ESG-based platforms are being developed. For example, it is very interesting, the project that is currently developing the BIS with the Hong Kong Market Authority, which is sort of establishing a green bond platform, which in terms automatically shall attract investment towards sustainable project. This is the whole idea of underlying green fintech, and which is very much also currently explored by the European Commission, which in January 2021 has done this interesting studies exactly regarding sustainability-related ratings, data, and research, where it gives very well the state of the art of available technologies that can serve sustainability objective. The flip side regarding open data, the emerging open data and open digital finance model in respect to financial sustainable objective is, in my view, very little and less explored than the positive contribution that this paradigm can have. And in order to inquire this, we have to do a step back and make reference to the well-known disorientation regarding the definition of ESG factors. Our stable points are the FDR, which defines and anchors sustainability risks to the materiality spheres, and greater definitional efforts have been done by the EBI and by the European Commission, which has tried to highlight the various pillars of the ESG into this, I think, very representative graph. Now, the fact is that no mention is to the impact onto these separate spheres of data and technology. And if we try to allocate technology-related risk onto the ESG scheme, then we see and we start seeing that effectively the risks that technology raises in respect to each of these three factors can be manifold. And exactly these technology-related ESG risks have an own materiality dimension also. If we look at the Dieselgate scandal, this very well gives a sense of it, but also the adherence of technology relevant regulation can have also an internal sustainable effect onto financial entity to the extent that emerging technology-related regulation impose very high sanctions for the violation of their precepts. And this is why the upcoming European Open Finance model raises complex issues of coordination of horizontal and vertical data governance model. And since the horizontal data governance model address interests which are different from financial-related interests and that can be generally summarized into social interests, if we think of the GDPR, the AI Act, Digital Service Act, Digital Markets Act, all have the ultimate rational and regulatory objective of protecting data subject, of creating fair digital markets, then we can start looking at the development of adequate compliance schemes that properly coordinate various normative levels in terms of data governance, start to address some of the social impacts of technology risk. However, the still persistent regulatory gaps in terms of consideration of technology-related sustainability risk suggests the need of the adoption of proper governance model. And here I come to an end because I think that my time has just stopped, but just to give you two last ideas of what I'm looking at currently is that a possible first venue for addressing at theoretical level, for addressing these technology-related sustainability risks may be found in both the notion of forward compliance and corporate digital responsibility. Now, the notion of forward compliance exactly hints at the need of developing in respect, and this is very suited for digital regulation, the development of a compliance strategy that holds account also for the risk that has not been yet internalized into regulatory schemes. And so this forward compliance approach lies exactly at the crossroads of the compliant and the risk management functions and the board management strategy. And so a forward look approach to compliance shall involve exactly the elaboration of multi-level data governance model capable of adequately internalizing also technology-related sustainability risks. And this, a first normative grounds, is exactly given by the DORA and the Corporate Sustainability Due Diligence Directive. This is why, very quickly, the DORA actually focuses on the alignment of business strategy and ICT risk management, and with the management body being required to have an outright active role in steering the ICT risk management framework with a full responsibility, and with also a further task, which is to be found in recital 36 of the DORA, to also try to build within the financial entity a strong sense of awareness over ICT related risks. And this I find quite interesting. A particular ground of this management and strategical approach to the governance of ICT risks shall be found in Article 25, which requires the management body to adopt and regularly review a strategy on ICT third-party risks in relation to critical functions, rooted in a continuous screening of all such ICT third parties dependency, which of course are destined to grow in an open finance model. Shifting back to the second side of the proposal of a directive on corporate sustainability due diligence, I do not want to enter in the criticalities and ineffectiveness and the shortcoming of this directive. I here just take a positive approach just for what I need. So in respect to the version of the Parliament of the European Parliament proposal, the final proposal of the European Commission just very slightly touches upon the realm of a director's duty. It, although nonetheless establishes director's duty to set up and oversee the implementation of due diligence and to integrate due diligence related to ESG factors and to integrate it into the corporate strategy. And there is this requirement to take account the human rights, climate change, and environmental consequences of their decision. Now, What is interesting to see is that the proposal of Director on Corporate Sustainability Due Diligence adopt an exceptional regime for financial entity, restricting the notion of value chain, restricting also the realm of a corrective and of mitigating action that financial entities have to take along the value chain. For example, in the value chains, no consideration is made, and this I find a shortcoming exactly in this systematic approach. No reference is to be found of ICT third-party providers. And so just to sum up very briefly, though both regulations surely have some shortcomings, this coherent and systemic approach I intend to take regarding these three parts of our triangle regarding open finance, digital finance, and sustainable strategy the finance, I think that a combined reading of the DORA and the Corporate Sustainability Due Diligence Directive can lay the ground for normative foundations for exactly this forward compliance to technology-related sustainability risks, which is very much needed in this increasingly open digital financial system. The DORA sets financial entities management bodies' tasks and responsibility to define adequate data and technology governance strategies, which are rooted and shall be rooted in both vertical and horizontal open data requirements. This in accordance with a risk-based approach, which exactly shall take account also risks related to third-party provided assets and based on the mapping and monitoring of third-party dependencies. And this strategy shall exactly identify the actual and potential adverse impacts onto human rights and environmental impacts. And this may involve also the duties for directors to take into account the human rights, climate change, and environmental consequence of the data set and technology, which are either developed or outsourced. And so this approach also adopted by the management body shall reflect also sustainable data management culture, also mitigating conduct risks, which are increasingly related also to data and technology. And in accordance with the tool proposed by the Corporate Sustainability Due Diligence Directive, this strategy shall comprise also preventive and corrective action plans defined in consultation with relevant stakeholders. I find this tool also very interesting because also increasing studies point at the relevance of experimental government solution regarding technology, and this could be also a relevant element to be internalized into financial markets, financial entities' governance of these technology-related sustainability risks. I thank you very much.
Super. Thank you, Giulia, for taking on a very important topic, or actually bringing together two important topics, merging two mega trends, if you like, into one. If you allow me, I'd like to push you on one point, and I'm happy to again have others come in or leave time for questions, answers afterwards. But one thing that puzzles me really is that the combination between technology on the one and sustainability on the other seems to be in conflict frequently, right? At least that's the historical assumption. So we all remember the story around the early blockchain models, right, which were fantastic and promising, and everybody was very hyped on, but it quickly turned out that they were actually quite heavy on energy consumption. So the computational power that we need for all of the data and the storage of information is massive, right? And so there are now supercomputers being constructed at the ground of the sea in order to cool them down, right? Because otherwise they would be too warm. So in other words, there seems to be an inherent conflict somehow. And yet, on the other hand, as you pointed out, there's also great opportunity in having technology solve some of our sustainability puzzles, right? So providing information, making it available everywhere, this seems to be inherently logical to me. So question to you is, how can we as researchers go down the right route? And probably even more importantly, how can we convince policymakers to harness the good potential of the game?
Yes, thank you very much for the question. Of course, it's a very general question. I think that, as you rightly pointed out, the benefits are more considered at regulatory and policy level than the downsides, actually. I mean, I think at least as far as the legal analysis shows, because there are many studies in the business realm that, of course, are dealing with green fintech and are exploring also from the technological standpoint the potentials connected to these technologies. At legal level, for example, the first internalization of this consideration is to be found, for example, in the corporate sustainability reporting directive proposal, which also requires the digital tagging of the information to be released. And this is an indirect acknowledgement of the potential of the technology for exactly the analysis and thus the reuse of sustainability related information. My sense is that these technology related the risks given by technology along this threefold chain of ESG are not yet fully inquired at legal level, and so this is why my interest is in finding appropriate governance structures that can fill the gaps of what the regulation doesn't tell us yet, maybe. But the DORA is a first example of the importance also of the governance and of developing adequate strategy of ICT risks. And I think the DORA can be very interestingly interpreted also from the lenses of the sustainability finance perspective by also and helping us including through this systemic approach in the realm of this very broad definition that the DORA places in respect to ICT risk, also to the risk that ICT models can have onto the achievement of these onto the protection, not the proactive maybe favoring, but at least the mitigation of risks related to these three ESG factors. And of course also the corporate sustainability due diligence is, I think, with all its shortcomings, an important, at least ideological, if I can say it, step forward also in addressing these the internal corporate governance mechanisms. And also a very interesting, I think, suggestion that DORA tells us regarding the possible way forward in the governance of these ICT risks, read through the sustainability lens, is also the holistic approach that it provides and that it suggests in respect to the whole management body. And this is very interesting because we are talking, many studies are dealing with the problem of technology committees also in financial entities. Is this an effective solution for the governance of technology risks, or a sort of, or do they entail the risk of technology washing of these problems? My sense is that a holistic governance also within the board of directors of these ICT risks can also give a better account for the transversal and horizontal dimension of technology once it has penetrated at all the levels, also at the ESG level in terms of positive contribution of financial entities. And it is not a case that the first, and also in this regard, I didn't have the time to correctly look at it, but also the notion of corporate digital responsibility, which is to date being tackled down by the German government and the French government, exactly offers also this transversal perspective, because the definition that does not yet exist at legal level, although legal scholars and specifically Professor Möslein is trying to read this notion of corporate digital responsibility as a development of the notion of the very general notion of corporate social responsibility. The business studies that are currently existing regarding the notion of corporate digital responsibility exactly point at the transversal nature and the horizontal and the need of a horizontal governance of these sustainability technology related risks. exactly involving not only separately the risk management function, the compliance function, all the governance strategy of the board, but exactly trying to connect these 3 points of the internal governance model. And I think this perspective, in addition to the more general perspective of trying to systematize the various levels of development of the European financial system, I think also this deeper governance models that are slowly arising, and the DORA is the first example, read through the lenses of the due diligence directive, may give first tools in order to bring the discussion and also the practical solutions forward. A last point that I wanted to stress is also the importance of the dialogue with stakeholders, which I think is also a relevant tool in order to address and to, first of all, identify technology-related sustainability risks. Of course, the stakeholder dialogue, which sort of underlies this whole idea of experimental governance of technology and of technology risks, which involves the putting on the table of more than one stakeholders, may have also downsides in terms also of stakeholder washing again. So the problems, opportunities and risks are everywhere, at least, but I think this is why it is such a challenging and interesting field to look at.
Thank you. Yeah, I mean, and when I was listening to you, I thought maybe, you know, as a sort of bridge to the previous discussion of Agnieszka's paper, that there might also be a political economy perspective here, right? That in a view, you could say at the moment, those two topics at the European level are treated completely separately, at least for the most part. And you may wonder whether legislators even talk to one another. I mean, so people supporting the, you know, working on the DORA proposal, I'm sure they don't really talk a lot to the, you know, taxonomy and ESG people. So then you might wonder, you know, what's the interest of technology firms in influencing what's going on in shaping legislation? So I guess there are, maybe this is a broader question for the discussion later towards the end. Maybe we don't have time to discuss that now, but that might be an interesting point that can connect the two sessions. So just some food for thought for further discussion a bit later.
Absolutely.
Okay, if you allow me, then we move on and bring in our third panelist. So it's a great pleasure to welcome Federico Riganti. I actually don't need to welcome him because he is all welcoming us. He is the main driving force behind this event and this event series. Federico is an assistant professor of economic law and capital markets regulation at the University of Turin, and he has a Ph.D. in corporate law from the University of Bologna and has been working on all sorts of aspects of corporate governance and financial regulation. The topic that he presents today has, I think, is winning the race for the most curious title. The title of the paper is ESG in EU banking and insurance sectors. Is this just blah blah? And we're very curious to find out what the blah blah is and whether we are actually just the whole time talking about blah blah. So Federico, floor is yours. Thank you.
Thank you very much, Professor Ringe, and thank you all. Yes, what you say is totally correct. I try to do something. I mean, I try to manage these seminars, and I'm really happy that at the end of the day, it seems that everything is going perfectly. And I really wish to thank you all at the beginning, and wish to thank you also EBI, EUSFiL, Filippo Nunziata, Michele Sira, and so everyone, because actually I think that these kind of seminars are really important for me, for my friends and colleagues, and so thank you very much. Yes, it's true, my title sounds like a good title. Probably I bet everything on the title. Try also to focus on the content right now. I must admit that Agnieszka and Giulia, I mean, friends, you made my job quite hard. It's like to take the exam just after 2 top score students. Your presentation were absolutely great, and I guess that there are some point in connection also in common with my presentation, because at the end of the day, the thing I would like to discuss together, it's the I would say, the real content of sustainability and why it is so important for banking and insurance sectors. We know that ESG is very important. As you, Professor Ringe, said before, nobody can escape from sustainability nowadays. It's totally true. But it's also true that probably too many of us, or too many people, are discussing about that. And at the present date, I would say that it's not so much clear what is the final goal, what is the real meaning of what we are all discussing about. Of course, I'm not pretending to tell you which is the meaning. The thing I would like to do today is just to point out some warnings, some question point or red flags, or I would say basically something I'm not totally understand, which I guess we should pay attention at, because we are probably working right now around a very crucial topic for our future, even more if related to these two pivotal sectors, so banking and insurance market. And therefore, it would be very important right now to perfectly understand at the beginning which is the real content of the subject matter. I will also try to point out some problems, or at least the complexity of this topic. And I would like, at the end of this presentation, also to pay attention at the cost of sustainability. And of course, also to the need to properly allocate these costs between public and private sectors. I guess that sustainability is something very big, and therefore it's something that probably should be managed not only by privates, but also to public players. And I guess that the regulation we are now studying, it's sometimes too much more on, try to skip the problems too much on banks and insurance and other private sectors, as I will tell you later, and this should be a problem. I have to disclose one thing before. First thing, as I told you, my presentation, it's more about wording, so I will not provide a solution or answer, but just questions. And also in the light of a discussion, and I adopt a kind of, I would say, skeptical and also a pro-market approach. I think that it's very important to, at the beginning of this presentation, and even more at the beginning of a study on sustainability, to better understand which is our approach, not only our legal approach to the subject matter. And this is because sustainability, it's something which has very broad perimeters. It's something very big, and therefore it's something we need to understand. Before I told you that I would like to understand, and something I'm not understanding is the meaning of sustainability. The point is that one thing is the definition, and as also said before, we have the definition of the risk of sustainability, but the real meaning is probably something else. And in my opinion, this kind of very foggy approach could be a problem. And why? Well, actually, it's because, as Giulia said, we are all saying nowadays that we need to adopt a kind of holistic approach. So try to understand the subject matter, keeping in mind all the possible scenarios that are around us. This, I guess, is quite a problem, even more when we need to bring back sustainability to our, let's say, legal field. One thing I would like to focus is the distinction between ethics and law in this subject, because I guess that many times there is this kind of risk of confusion. We know that there is, I mean, I would say very, very important scholars and philosophers discuss a lot about the need to properly understand this kind of responsibility of humans towards environments. This is totally crucial and very important. But the important thing, in my opinion, is not to confuse these kind of things, so this point of view, with the real goal of the regulation. So one thing is the regulation we should talk about. Another thing is an ethical approach to the problem. In my personal opinion, the regulation should be technical, and therefore, in studying this subject, we should, I would say, not taking into account an ethical dilemma. We should think that we are doing this kind of reasoning for, I would say, a final goal, which is a goal strictly related to the economical sector, to the business. I told you before that I prefer to adopt a pro-market approach. Something I would like to say is that In my opinion, sustainability is a meaning, therefore, not for ethical reasons, I would say, not for other kind of reasons, but for what is about our point of view, has a meaning only because it's a core element of our business. And which kind of elements? Well, it is a risk. We know, and also Giulia before remember us, that the main point is that sustainability is a risk to be no more sustainable in future, and I would say something more, to be no more financial sustainable in future. So we need to change. But this kind of need, I would say once again, should be totally disconnected from other needs like the ethical ones. This kind of new approach I'm talking about, so this kind of need to manage the risk of sustainability, it's so big that, in my opinion, it could be a real problem if the risk itself will be put on private sectors only. Sometimes it seems, and even more when I studied banking and insurance sectors, that banks and insurance nowadays are, of course, extremely important for sustainability. Lawmakers say that banks and insurance will be probably crucial for the transition, but sometimes it seems that public sectors try to, ask banks and insurance, but also other private players, just to think about the problem. I don't say that public players are not thinking about that. But the thing is say that if we ask private players to manage the problem by themselves, well, we could face a new risk. And the risk is to come from the sustainable business to a new risk of need to talk about the business of sustainability. And actually, the fact that this kind of topic exploded in the last years, I guess it's a kind of sign of this kind of thing. I mean, one thing is approaching the problem under a public point of view, something that, in my opinion, it's very important, even more if related to the social aspect of the ESG topic. Another thing is to ask private player to think about that. And of course, and in my opinion, this is totally correct, if you ask private players to manage the problem, private players will manage the problem in the best way possible for their interests. And this will lead also me to talk about another issue later on about the distinction between shareholder and stakeholder. We have, of course, many elements of complexity we have to think about right now. Some of them are already known, some other not. Here there is a list, which in my opinion are nowadays the most important ones. First of all, I think that, and I guess that everyone could agree on that, the actual terrible situation in Ukraine, it's a problem also for what is related to sustainability. It's something that we also discuss about, broadly speaking, at the end of the first presentation when we talk about energy. I mean, nowadays, energy is the problem. And it's also clear that between European member states, there are many different approaches to this problem. The energetic problem, I would say, it's probably the biggest problem we have right now. And I would like also to point out another problem. We are now discussing about finding new way of getting energy no more from Russia. This is clear to everyone, but I don't think that the new way we are finding right now, so the new countries we are finding agreement with, are so much sustainable or pay so much attention to ESG goals. And this is another problem we should keep in mind. The second point is the fact that we have a regulation, a legal framework that it's always ongoing. And in my opinion, that it's too much characterized by very hard technical standards. I perfectly know that this is, this is how it works. We are talking about sectors which are strictly under control of the ESAs, of the authorities. So technical standards are probably the core element of the regulation, but another thing I would like to underline is that the fact of having this, the consequence of having this kind of ongoing legal framework, the fact of never know if the regulation or the, I would say the every other source of law, we can call it in that way, is the last one and most updated, it's a big problem. And this is, in my opinion, a real push to this so-called greenwashing. I mean, at this time, I guess that the regulation is too much confused and is too much, I would say, and many times it's not perfectly connected one each other. As also Giulia was saying, this is another big problem. It's not an incentive to be sustainable, because actually the cost of compliance, it's quite big. The third point is about the topic I anticipated before. So we said that sustainability is crucial. We said that we need to be sustainable, and actually we said that we need something allow us to, or impose us to be sustainable. I said before that for what is part of my research, but I guess that this could be affirmed by everyone. Banks and insurance are crucial for this topic, for this transition. But the things I would like to ask myself is, okay, this is great, but at the end of the day, we are talking about private companies. So we're talking about companies which should also keep in mind that they are working for a final goal that could not be ESG related. It should be, or probably it will be, but, or it's going to be, but right now we have not to forget that also the shareholders' interests are crucial for the business itself, and therefore, and this is a very big topic I cannot discuss right here today. By the way, also when we talk, also under this point of view, when we talk about the fact that banks and insurance should be sustainable, we probably forget that banks and insurance should also work in order to make profit, in order to realize interests of their shareholder. This is a very crucial point, and I guess it's crucial also for what, in the light of what Professor Grunewald said before, so the distinction between real economy and financial system. I will be back on this point later on. Last point, the one that you and Giulia discussed before, sustainability and technology. This is totally correct. I mean that this is a crucial point for banks and insurance. We are talking about, let's keep in mind InsurTech to make an example. Let's talk about artificial intelligence in these sectors. Artificial intelligence means that the artificial intelligence should also be connected to ESG goals, yes or not, and how. And even more, how we could fix technology and sustainability, how they could have, I mean, they could put on the same tables and have a dialogue. It's not easy at all. If I'm not wrong, if I correctly understood, Giulia brings the problem of technology under the, let's say, the umbrella of the G of the ESG. So it's a topic, a problem of governance. It's true, but I'm not totally sure that this is the only one. It is, of course, a problem of E, with reference to E, so the environment, but we cannot forget the social impact of technology and the fact that technology is growing and that actually it's also having like an internet connection, using technological device and so on. It's becoming to be considered a human right, and therefore technology will be probably become, I would say, the main point of the future ESG discussion we're going to have. These are elements of complexity. We have, I would say, also difficulties when we need to understand which should be the best approach and which should be the methodological again approach we need to adopt when studying ESG. Here there is the first bullet point. It's about something I consider very important. So the fact that we need to forget a kind of political correct approach. I would say that this is linked to the ethical topic I discussed before. The topic is that at the end of the day, once again, we're not talking about ethics, we are talking about business. And here again, we should point out which probably we should also study better the distinction between long-term and short-term. Something which is crucial for sustainability, of course, sustainability is more long-term linked, but the fact is that I feel that there is a kind of a bias against short-term. And I mean, the things I would like to underline is that not by default, short-term could be the worst approach ever. Another topic, and I try to run a little bit more, it's about the problems related to the matrix concerning ESG, the scoring of the ESG, and I would say also the connection between these three layers. This is crucial for banks and insurance and has a deep impact on these companies. And when I say this, I mean that has a deep impact, strong impact on directors of these companies. I mean, what we are expecting from the directors of banks and insurance? I guess that their work it's already quite difficult. And if we ask them to be also sustainable and ESG compliant, I mean that we are giving them new threshold to be respected. We are giving them new goal to be scored. And this is not easy because with most of probability, there will be friction between ESG. So which one must be the right one when the directors has to take the decision? I guess that on this topic, the business judgment rule principle must be kept in mind. But anyhow, I guess that the fact of asking directors of banks and insurance to be sustainable, it's a very difficult problem to be resolved. And it's a problem that also have impact on the topic of corporate governance. We are going towards an enlightened corporate governance, probably yes, but I would say keeping in mind which is the, for example, the approach of the Italian, the Bank of Italy, I would say that nowadays the regulation already tried to face this problem, and it's not easy at all to find a solution. It means that we have more costs. What does it mean to have an enlightened corporate governance? To creating new committees, to make an example, could be, but we cannot have board made by committees and committees. Coming to the cost, and probably, and I have just a few minutes to left, I would say that the crucial role of banking system must be understood if we point attention of the where to allocate the final cost. And this is the topic that probably was anticipated before by Professor Grunewald. It's sustainability a question of real economy or of financial sector? Who knows? Is sustainability a question of private law or public law? Who knows? Probably both, but the real problem is that banking system, it's exactly in the middle of real economy and financial sector, and is in the middle between public law, public sector and private sector. This means that it's not easy at all to match incentives to go sustainable and the cost of sustainability. And the same type of problem we could face also with reference to insurance sector. Insurance must, of course, keep in mind the problem, the risk of, for example, climate change. This is totally clear to everyone. But here I see another problem. Sustainability, it's something not yet fixed. Probably things are going to change even more if we look at what is going on around us. So why should we fix our governance, our goals, our agenda to something that it's not been already fixed? This is another great topic we should better understand. In the end, because I guess I have no more time, I mean, it's all about just a blah, blah. I think it's not. I think this is a very crucial problem, but the problem is not, I would say, sustainability itself. Probably is the approach we're having, we are adopting in order to understand sustainability. Probably it's not a blah, blah, but it's also blah, blah. And we should better understand what to do for getting other problems which are sustainability linked, I would say, but which are not the real problem we should face right now. At the end of the day, the important thing will be, in my opinion, that every step we're gonna take towards sustainability is the cost. even more for banking and insurance sectors. This means that it will be also a cost for clients, it will be a cost for shareholders and stakeholders, and therefore that, especially in these kind of sectors, the transaction cost of the transition will be very high. And therefore, I guess that we should now stop, think about these kind of problems, and probably try to reallocate the agenda more up to the public and less up to these private companies like bank and insurance. And that's it. And I guess, and I hope, Professor Ringe, to be on time.
Super. Thank you so much, Federico. This was really thought-provoking and a big high level on the topic. And I think a perfect moment to open up the discussion to everybody. So you're all welcome to bring in questions. All the participants, please do use the chat or Q&A function, and then we try to integrate your questions. Panelists are, of course, also very much encouraged to respond to each other so that we have a bit of a discussion also in that link between the different sessions. But I first give now the word to Rainer, and you may want to comment a bit on Federico's and Giulia's presentation.
Thank you very much, Georg. Yes, I would like to take the opportunity to thank you both for very insightful presentations on your individual challenging topics that you're pursuing. I have a few comments and a few questions, if I may. The first comment is really sort of following up on something that Georg said earlier, and that you mentioned, Giulia, in your presentation, that in the digitalization realm, we talk more about the benefits rather than the adverse effects of the digitalization, whereas in the realm that is really completely different from the digitalization, in the realm of sustainability, it's actually precisely the other way around. We speak always about the adverse impact or the costs, and we heard it again in Federico's presentation. Actually, the costs of the sustainability transition is what we talk about and not the benefits. So I wonder where this comes from, that we have these two very separate domains where regulators don't seem to talk to each other, and where we look at these developments from a completely different perspective, even though both developments have both benefits and adverse effects or costs. So that's just something that sprang to my mind, and I wanted to share. Maybe I'd love to hear what you think the reasons are for this, perhaps. The second point is also of a general nature. We have been discussing a bit the different meanings of sustainability, and it sort of seems to be the general idea in this panel that we don't really know what is meant by sustainability, or there is a lot of different meanings that we can attach to this term or this concept. Now, I would like to make the provocative claim here that actually we do, or we could have a rather clear idea of what is meant by sustainability. We do have the Sustainable Development Goals that are actually quite substantially discussed in terms of both their co-benefits and the trade-offs that these different goals generate. And of course, we can discuss about the details or questions of implementation of these Sustainable Development Goals, but they do give us actually quite a holistic and good picture of what could be meant by sustainability. I wanted to put this up for discussion as well. Then I have a quick question to Federico. You mentioned both insurance companies and banks in your presentation, and I was just wondering, do you look in more detail into how these two different, quite different sort of types of undertakings, with very different business models, how sustainability matters differently to these two sectors? That would be an interesting point for me to clarify. And for Giulia, just also out of curiosity, my question would be, you mentioned that corporate digital responsibility, which I find a hugely interesting concept, by the way. But you mentioned that it's discussed at the policy level and also in literature, but it's not really part of any regulatory effort so far. Now, my question is, why is that, you think? Is it just a matter of time? Is it coming? Or is it really something that regulators are sort of afraid to touch? Or, you know, what are the reasons behind the fact that it is only discussed at the policy level, but it hasn't really found its way into the legal context? So thank you very much again.
Okay, well, these were probably about 10 questions in one, but I guess there was something for everybody. So maybe we go through all three of you and you all can pick and choose, you know, be mindful of time, pick and choose some of the issues that you would like you feel comfortable of commenting on. And where we go in the reverse order, we start with Federico, then Giulia, and then Agnieszka can pick up some of the points as well.
Yes, great. Thank you, Professor. Well, I would say, yes. First of all, I'm now researching this topic, so the distinction between bank and insurance. Even though I would say that by now I find more similarities than distinction, in the sense that if we define the sustainability as risk, actually risk is a core element for both banks and insurance. So it's I would say under this kind of business point of view, they are quite similar. They could have a kind of similar approach to this problem. Another similarities concern the corporate governance structure, in the sense that in the end of the day, I would say that the structure of the board, the internal control system, and so on, it's quite similar between banks and insurance. And for both of them, ESG and sustainability, it's a core element. I'm thinking about also the fit and proper requirements of directors or other stuff like that. Something I'm a little bit worried about, it's about the qualified holdings in banks and insurance, in the sense that by now the important thing is the financial sustainability of the acquisition project, and no one is talking about other type of sustainability of the acquisition project, but it will probably come out in a few months or a year. By the way, this is a great question, and of course there will be distinction. I'm searching on that, and I promise I'll be back on with more details in future. And coming to, in 1 second only, coming to the fact that sustainability has been already defined. The meaning is the one of the goal. We know it's totally true, but I guess that the point is that we have to understand, if we wish to adopt, I would say, a more technical approach. So we have to read documents, understand what is written inside, and fix kind of elements. As goal we have to score. Another thing is to, and this is more about blah blah, say we need to change our way of life. We need to again modify everything because we are terrible with the environment, bad guys, and so on. And if we focus on this second point, here we could have problems. This is a blah blah, and I guess that this blah blah is a problem because it's a cost. And because at the end of the day, people will not so much be, I would say, incentivized in understanding that type of sustainability. So it should be no more, I would say, not so much about a general question rather than a very probably financial and particular topic.
Yes, thank you, Professor Grunewald, for all these really interesting questions. So I'll try to take the least time possible with my answers. But first of all, a very important, I think, takeaway of today's discussion is exactly that while, as you rightly pointed out, while the financial sustainable finance realm exactly addresses these issues of adverse impacts, the digital sphere, the digital flip side, actually seems, as I have argued, do not take into account of the adverse impacts onto the ESG factors of the digital related transformation. And just a very quick comment to Federico, my point is not to just address the governance pitfall of technology transformation, but the governance of technology-related ESG risks, okay? because there is not always environmental, but also social, and then governance, which can be everything, can be considered as a blah blah. It is also interesting that the European legislator has decided to take out the word governance on the corporate digital on the corporate sustainability due diligence directives. This is also relating to blah blah, maybe a suggestion toward this. But this leads me, so technology has an enormous social impact, because the social factors, as the Commission has explained very recently, relates to human rights protection, to workers' rights protection, to diversity issues also. And exactly these are all realms upon which technology has an impact on. Think about the technology-driven HR processes, which are very much used also in the financial sectors, the monitoring of employees through digital technologies, and ultimately in the financial sector, especially the problem of self-determination of customers. Think about chat box, automated driven chat box, which may provide recommendation for investment, or also digital market lending platforms, which direct automatically investment and match demand and offer related to investment. So the social impact is enormous, and has not been, the question is, has it not been yet inquired? Well, I come from a digital markets regulation background, so actually this is all the point regarding this exact social impact has been the very much focus of all the discussion related to digital markets regulation. So again, the problem is to bridging sustainable finance and all these discussion which have been going on starting from 10 years with Frank Pasquale and so on, regarding the social reflexes of digital transformation, which equally are impacting in the financial sector. So it's about taking an interdisciplinary approach, which really tries to bridge and most of all take advantage of the already existing research and policy and regulatory results. This is why the important to matching vertical and horizontal regulatory perspective to exactly effectively direct the financial markets development toward an ESG sound digital development. So this is a very important perspective in order to exactly address this mismatch that is at present existing. Now, in respect to sustainability development goals, there is a very interesting recent paper from the Hong Kong Finance Institute, which exactly points out that the differences in ESG related regulation and sustainable development goals, because while the first one takes a risk approach and the perspective of mitigating and minimizing ESG related risks, so the sustainable development goals takes a more proactive perspective. That exactly what this proactive perspective that both at corporate law level and also at financial level there is a problem in taking, exactly because it clashes with profit-oriented structures of these legal system. And so the problem here is to Agnieszka was very interestingly referring to legal transplant. So the sustainable development goals through the financial system would be really a sort of legal transplant, which could, as Professor Teubner says, also trigger irritants, legal irritants. And this is the whole perspective regarding the problems of matching the profit-oriented approach also of our corporate governance system with non-financial interests. So at present, the stance is that we have the stance that the European legislator has done is to demand the taken into consideration of these factors. So while maintaining our profit-oriented approach, just taken into consideration along the lines of this enlightened, we can say, shareholderism mechanism, which also Federico was mentioning. So quickly going to the corporate digital responsibility, yes, it's been inquired. There are many papers regarding business management, which deals with this notion at management level. At legal level, there are some studies by Professor Möslein, which try to contextualize this paradigm, which does not yet exist. And here exactly the problem is that the answer that I would give is exactly that for now, little attention has been given regarding the downfalls and the downsides of technology related solution in respect to sustainability related goals. And this is why at regulatory level there has not been taken consideration exactly of these. Of course, this may well be also a legislative political solution to not take, at least from now, consideration of it. The DORA could open up exactly some perspective, as I already was mentioned, but for now the developments are really at self-regulation level. And then I close, what I try to find really interesting is that the study by the European Commission regarding the impact of artificial intelligence onto corporate governance and corporate law in Europe, which exactly highlights that the financial markets, financial entities are the first ones who are also at corporate governance level. And here we take into call the governance side of ESG, are internalizing these AI-driven solutions also at corporate governance level, although this is the very futuristic, of course, development, but financial entities are the very first one who are addressing these problems. And the European Commission, in mapping all the benefits and risks, exactly highlights that the legal solution for now has to be found at self-regulation level, so no legislative direct stance. And this is what is occurring, at least in Germany, with the corporate digital responsibility initiatives, which has also drafted a code, the CDR code, which addresses exactly the social pitfalls of ESG, of technology driven solutions. But curiously, the financial entities are not involved or did not have yet adhere to this strategy. So also other industry firms coming from different industry sectors are sort of signaling their adherence to this codex, of course, for reputational benefits level. But I think this perspective of corporate digital responsibility, exactly because the financial sector is the most digitally developed, could be interesting and important. Thank you.
Thanks, Giulia. Agnieszka, you have, I think, which is already the final word.
Yes, just one thing that I picked, and I think we found an interesting number of threads connecting our research agendas. Just one point on the sustainability definition. I'm not exactly sure if the problem is under definition, because the taxonomy is a few hundred pages. So we have a lot of definitions when it comes to what environmental sustainability is, and that's being developed. The problem is, how far does it reach into people's minds and into corporate decision making? This is going to be triggered through various forms of disclosure, but again, this is the problem of who will explain to the corporates how they fit in the taxonomy. And where there is less clarity is obviously with regard to S and G elements. I'm not sure if I agree with Federico that there are necessarily trade-offs. I think there could also be a reinforcement, and applauding your stand with Ukraine stance. I think if we thought about environmental sustainability also with a stronger emphasis on human rights and governance, democratic standards, maybe gas wouldn't have been considered a transition fuel for such a long time as it was up until the 24th of February 2022. So this is food for thought, that maybe it's not just trade-offs, maybe it's also a reinforcement of the framework potentially treating the three elements together. And then I honestly had a question to Giulia, because the taxonomy also covers a number of IT data processing, and in the taxonomy there are some conditions relating to emission standards relating to the data processing and information technologies, and I just wondered if that fit at all, but it's maybe a question for another time, and I follow up on the by email, but thank you so much.
Yeah, of course. This is the first. I mentioned just the example of the Corporate Sustainability Reporting Director, which requires digital tagging, but this is a second sort of source of acknowledgement of the relationship. but again, in a positive perspective. So it's the contribution that these data processing can have in respect to all the classification and the activities that are addressed by the classification, but exactly the flip side of the risks is to be nowhere found at regulatory level.
Thanks.
And I agree with you, Agnieszka. It's not the definition, but it's the meaning, the real problem. So
In people's minds.
of course, absolutely. At the end of the day, it's always like that. Yeah. Thank you very much.
There is this saying that we should always stop at the best moment when the discussion is really heating up. So I think we've seen a lot of thoughtful discussion, no blah blah at all. It's been great to listen to you. And Serena, I give it to you to close our event.
Thank you very much, Georg. Yeah, I have not much to add to that. I think we managed to flesh out some really overarching themes between the three very different projects that you're pursuing, each of them interesting and intriguing in the questions they look at. So I would like to congratulate all the three of you for this interesting research work that you're doing, and to thank you for presenting here today. It's been a real pleasure, and we look forward to reading and hearing more from you in the future. Thanks a lot also to our listeners for being here today, and we hope that you profited as much as we did. And we hope to see you soon again at other EBI events. Thanks a lot to all of you.
Thank you. Bye-bye.
Bye-bye.
Thank you all.
Thanks so much.
Bye-bye.